Well, we could get those record closes for the S&P and the NASDAQ today, as I said. Liz Young-Thomas is SoFi's head of investment strategy joining us. Congrats again, Liz.
Thank you.
All right. Closing highs here. Heading into a Fed meeting, a CPI report, and everything else. How are you feeling about the market here?
I mean, there's obviously optimism heading into this, I think primarily about CPI coming in at least on expectations, if not a little bit cooler. And then we had a nice NFIB small business optimism index today. We had a pretty solid 10-year Treasury auction. So there have been encouraging signs. The data has been encouraging even just today alone. And this is after a few days of just kind of flat movement in the S&P. So not necessarily pullbacks, but just kind of a pause in that upward trend, which I think is in anticipation of all of this data. And remember, we also get PPI this week. So it's a really big week. And listening to what Jerome Powell is going to say tomorrow, obviously nobody's expecting a move in rates. But I think listening to his commentary on whether they're getting more confident that they are, in fact, defeating the inflation issue.
It's interesting because I feel like what was expected to be an even more significant period of time for the Fed and the meeting and everything else is maybe had a little less so, just because we don't expect a move tomorrow and we don't expect a move in July, and maybe we won't get one before September at the earliest. Does that change the calculus of how you think the markets may react to whatever happens tomorrow? No matter what the Fed chair says, I guess my point is we're going to have other economic reads on inflation and just about everything else well before we think there might be a cut anyway.
Right. And the way that I understand it, we know the Fed meeting started today. We get the statement tomorrow. The way that I understand it is that if there's important data that's going to be released during the meeting, they do get a heads up. So the commentary tomorrow should have that already incorporated. I think the market is going to trade more off of the data than off of the statement unless he says something that's unexpected. I don't think that's going to happen. I think that Jerome Powell does not really like surprises, and he's certainly not going to like that in a moment like this. So I think we're going to trade much more off of CPI. And I think as the summer goes on, eyes are going to be on the labor market more than anything. We just had that first 4% unemployment print. And I think if it gets higher than 4%, markets are going to have to digest that. We have been so used to a sub 4% unemployment rate that it could get jittery as things move in that direction.
Narrowness of the market matter to you at all? You know, here we are starting the show talking about Apple hitting an all-time high. Tech and comm services, the only sectors today in the green, and that's much like it's been of late. That's why the NASDAQ's been hitting these closing highs. Even the S&P 500, which has been too, has been powered by those big tech stocks.
Yeah, I mean, this is a tale as old as time in this cycle, so not something that we aren't used to already. I think that the risk appetite in the stocks that are leading the market and the fact that the AI theme continues to drive so much enthusiasm shows us that buying appetite is still strong, the optimism about the economy is still strong, and that the optimism about us being able to continue elongating this business cycle is still strong. So the market being narrowly led is always a concern because you get fragile from those points. You're hanging on to just a handful of stocks and hoping that they don't go wrong. But at this point, I don't think that there's anything standing in the way of even a little further upside, especially on a cool CPI print tomorrow.
What else would you buy if you're looking to move away from tech? And look, let's play it both ways, okay? Let's assume that the CPI comes in favorable tomorrow and nothing out of the ordinary happens at the Fed meeting. Remember, last go around, the market seemed to be overly consumed that Powell, the Fed chair, was going to be more hawkish than expected. He turned out not to be. It's largely the reason we were able to rally off of those April lows and get to that point where we're talking about new closing highs every day.
Right. So what I think could be very possible through summer is that, let's say we get a nothing burger tomorrow. CPI continues to cool. Economic data continues to cool. The market has cheered cooler economic data because it usually means cuts are coming. So I think we're likely to see a September cut, the probability of a September cut increase as summer goes on. But then you have to ask yourself what might happen to the yield curve as economic data cools. So as the data cools, I think we'll see what's called a bull flattener, which is where 2s and 10s both fall in yields, but 10s fall faster. And in that environment, including an environment that I think happens after that, which is a bull steepener, in that environment, you want short duration equities. You want things like staples, utilities, healthcare, and you also want energy. Typically, the dollar is weakening in that environment, which is a tailwind for energy. And I think energy is very attractively priced here, comparable to all of the other sectors that we're talking about on a daily basis.
The yield question is an interesting one, isn't it? You know, we have had this correlation, lower yields, higher stocks. In some respects, we're getting that, but we're not having that lead to this big broadening of the market and sort of a feel-better market. As we said, it's being powered by these bigger names. Yields down today. Okay, I get the S&P is on track for a closing high, but there have been times over the last 10 days where falling yields have not been a good stimulus for stocks. In fact, they've fallen because the assumption was, well, if yields are falling, maybe the economy is falling too, and therefore that's not reason to be overly optimistic at this moment about stocks. What do you think about that?
I think that's what we're going to deal with through summer, where we have this cooling in the economy that everybody has sort of begged for, and then it seems like stocks have begged for. And then what if we get to a point where it's too cool? And I'm not quite sure where that inflection point is yet. I do think, though, in the near term, if yields fall, both on the short end and the long end, stocks will celebrate it, particularly in those mega cap tech names. This, to me, because we haven't had that broadening out, this, to me, is more reinforcement of the belief that we are late cycle. We are approaching Fed cuts. We have large cap dominance again. We have an unemployment rate that was really low but is now on the rise. So we have a labor market that is cooling. We have GDP growth that was really, really strong, still positive, but is coming down and is slightly expected to be below trend for the rest of the year. This is all late cycle behavior. The only thing that I think people are hanging hats on from early to mid-cycle is that AI is going to somehow change the business cycle entirely, and I just don't think that's the case. So I do think we will go through a part of the cycle here in summer and early fall as we approach that first cut, where markets get a little bit jittery about, you know, we wanted things to cool, but how cool is too cool? And we'll probably see some bumps as that happens. There
are some who would say, well, hasn't AI already changed the business cycle? I mean, just through the spending that we've seen to this point, isn't this literally happening as we speak?
I think it has changed some of the reaction in the market. It's changed the market's reaction function, and it's certainly changed where I think consumer sentiment and investor sentiment would be if this didn't exist. So, yes, I agree with that. I think we're still at a point in that theme and the evolution of that theme where we need to figure out where the profit comes from. How do we monetize this? How do companies grow profit margins with AI into the future? Because as we know, this is a theme that we would expect to really transform industries for years to come still. And we're in the early phases of it. I think we're in the infancy of it. So as it moves and evolves, we have to find out where the profitability centers can be and who the actual winners are. I think those are still bigger question marks than some investments are showing in their PEs.
Interesting. You know, because I'm looking at those AI plays, whether it's Broadcom higher today. We know what NVIDIA's been doing of late, Microsoft and Meta, and, of course, Apple with its latest salvo in this whole thing is at a new all-time high today. Liz, we'll leave it there. Liz Young-Thomas, we'll talk to you soon. Thank you.
Thank you.